Fragile normalization. Easing of strong dollar. On March 23, the Federal Reserve announced unlimited quantitative easing and the direct purchase of corporate bonds, followed by a substantial fiscal support agreement on March 25. These combined actions of the Federal Reserve and the U.S. government began to stabilize the financial market, reversing the trend of turmoil and initiating a return to normalcy. The intense demand for U.S. dollars started to ease, leading to its devaluation. The Fed's commitment to printing unlimited dollars and purchasing corporate bonds made other investment options more attractive, reducing the dollar's frantic demand. The implementation of zero interest rates and ongoing COVID-19 impacts also contributed to the dollar's gradual decline. These monetary and fiscal measures alleviated the severe credit crunch, reduced panic selling, and restored the status of gold as a safe asset. The financial market began to function more normally, providing relief, particularly to emerging economies facing dollar shortages. However, the currencies of resource-exporting countries, heavily reliant on raw materials like crude oil, did not see substantial movement, indicating that a broader economic recovery, especially in demand for their exports, is still a separate and ongoing challenge. Overall, the Federal Reserve's and the federal government's efforts successfully eased the financial market's previous state of emergency, stabilizing the banking system and market functions. Strong recovery in stock market. On March 24, the Dow Jones Index saw a significant surge, rising by 11.4%, marking the largest point increase since 1933. This dramatic rise, mirrored by gains in other major indexes like the S&P 500 and Nasdaq, signaled a revival in investment sentiment and was further bolstered by the announcement of the CARES Act. The stock market's recovery prompted two contrasting perspectives. One viewpoint suggested a liquidity-driven rally due to the Federal Reserve's unlimited quantitative easing, projecting high-pressure liquidity to buoy the market despite dampened growth prospects from COVID-19. Conversely, others cautioned this might be a temporary, dead cat bounce within a larger bear market, emphasizing the lack of real economic improvement to support a sustained recovery. Some remained optimistic, viewing the crisis as an external shock with potential for a swift V-shaped recovery, believing in strong economic fundamentals and the temporary nature of the pandemic's disruption. The stock market's movements reflect these diverse interpretations, with future economic indicators yet to fully reveal the trajectory of recovery. Wings for the fallen angels. The Federal Reserve's response to the COVID-19 crisis included significant measures to stabilize the financial markets, notably by supporting fallen angels, or corporate bonds downgraded from investment grade to high-yield status. Major companies across sectors, impacted by the pandemic, faced challenges in bond issuance and market trading. To address these issues, the Fed expanded its purchasing programs on April 9 to include high-yield bonds, collateralized loan obligations, and commercial mortgage-backed securities. This move, aimed at stabilizing the corporate bond market, was metaphorically described as giving wings to fallen angels. The inclusion of riskier assets in Federal Reserve's purchasing programs raised concerns about the potential for creating zombie companies and the moral hazard of encouraging risky investment behaviors. Despite these worries, the overwhelming need to stabilize the economy and prevent lasting damage took precedence. The Federal Reserve's actions, supported by substantial capital from the CARES Act, led to a noticeable recovery in both the corporate bond and stock markets, with ETF prices for corporate bonds rebounding significantly by mid-April. In addition to supporting the corporate bond market, the Federal Reserve introduced several key programs to aid various sectors of the economy, including the Paycheck Protection Program Liquidity Facility for small businesses, the Municipal Liquidity Facility for local governments, and the Main Street Business Lending Program for mid-sized companies. These initiatives, along with the expanded scope of Federal Reserve's asset purchases, underscored a comprehensive effort to inject liquidity, support businesses, and stabilize the financial system during an unprecedented period of economic turmoil. Oil flood. The oil market underwent a dramatic series of events starting March 8 when Saudi Arabia escalated a price war with Russia by boosting production, leading to a precipitous drop in international oil prices. The situation worsened due to reduced global demand amidst the COVID-19 pandemic, causing a 25% decrease in daily oil demand and critically limited storage capacity. The U.S. oil industry was particularly hard hit, with a significant portion of oil and gas company bonds at risk of default and companies like Whiting Petroleum filing for bankruptcy protection. In an attempt to stabilize the market, major oil-producing countries agreed on April 12 to cut production by 9.7 million barrels per day. However, on April 20, international oil prices, WTI, plummeted to an unprecedented negative $38 per barrel, mainly due to the acute shortage of storage space and technical issues in the oil futures market. The situation was exacerbated as traders, unable to physically store oil upon contract expiration, were forced to sell at negative prices. This marked the first time in history that international oil prices entered negative territory. The subsequent recovery in oil prices was influenced by the Production Reduction Agreement and Saudi Arabia's decision to increase crude oil supply unit prices for June. This recovery signaled a shift in strategy away from the market share competition, as Saudi Arabia began restructuring its finances, heavily reliant on oil export profits. The sequence of events in the oil market highlighted the volatile interplay between supply, demand, storage, and financial market dynamics in setting the benchmark price of international oil,